On All About Stocks this week, the Nifty hit 6,700 for the first time. As the markets cheer, we'll tell you what your investment strategy should be. We focus on mid-caps and tell you where you should be investing your money. And we sit down with market guru Puneet Nanda to ask him what investors can do to make the best returns in this market. You're watching All About Stocks on ET now. Thank you so much for tuning in. Now, it's been a very exciting week for us in the markets. Fresh all-time highs made both on the Sensex and the Nifty. We're looking at a stronger rupee as well that breached 60 to the dollar. And we're looking at lower inflation. We've been Asia's best performing currency in March. Over the next half hour, we'll tell you how you can benefit from all of this information and how you should strategize your portfolio to make the most of the months to come. We'll also be answering the questions you sent in during the week. Remember, if you have any question about your stocks, write to us. Our email ID is at the bottom of your screen. Now, let me bring in my colleague Avan, who will give us an update on how the markets performed while you were in the office. Avan, take us through what happened.
Call it irrational exuberance or a well-deserved rally. I don't think there were any complaints. You wanted to do a double take after seeing the way we rallied this week. 6,700 on the index, record highs day after day, and we wrapped up the week with a gain of close to 3% on the frontline indices. Broader markets weren't too far behind, and they too gained. Lots of factors can perhaps be attributed to this. It was the currency, which in fact breached below the level of 60 to the US dollar for the first time since the 30th of July. You also had FIs, which continue to be very bullish on the Indian story, the pre-election rally, and the global backdrop, which continued to support us. It was clearly PSUs, which was the strongest basket, gaining over 8%. PAR as an index did well. The bank Nifty has gained over 6% this entire week, and capital goods also fared on the upside. You had pharma, which was a bit sluggish, and IT on account of the way the rupee panned out, which shaved off close to 1%. But all in all, it was banking stocks all the way, so the likes of PNB, IDFC, SBI, Hero MotoCorp were some of the top gainers. Dr. Reddy's, Sun Pharma and HCL Tech lost out. Midcaps did fairly well. BF Utilities saw a 25% notch up. Ashok Leyland also did well for itself. On the downside, MRF and ENIL lost out. But of course, it's been a stellar week for the frontline indices as well as for the broader markets all in all, as we wrapped up expiry as well. Next week, we'll be watching out for the all-important monetary policy.
Thanks, Avan, for that update. Joining us today in the studio, Prakash Diwan, Director at Altamount Capital Management. Prakash, thank you so much for coming in. It's always a pleasure to have you in the studio. What a week we've had. A stronger rupee, lower inflation, an RBI policy coming up next week, and of course a market that's even so by 10 points every day, hitting a new high on a regular basis. Try and explain to us what's going on here. Is it purely FII money? Is it a pre-election rally? Do you expect it to go on right up till the elections, or is there going to be a correction before then?
I wish I knew that so well. But let me rationalize the rally.
Yes.
That's at best what we can do. There has been very clearly a coincidence of positive triggers. So it's like serendipitous of sorts that everything good has fallen in place together at the same time. Namely, China, Russia, Brazil getting into their own set of problems. So we've been in a sweet spot. The US yields on the debt side have not been encouraging, so there's a lot of money after the taper that started coming out. Now, to match those kind of yields in your portfolio, you need equity returns, and emerging markets are the best way to do that. And that's where money is poured in, because the Dow and the Nasdaq and S&P also are at all-time highs. So it's not easy for people to look at only the US markets to make that alpha. And thirdly, whatever RBI did 6 months back, ever since Dr. Rajan came in, I think has started having that effect, that impact of sorts, and particularly on the currency. I mean, it's a brilliant move that is paid off well. Not something that would draw admiration from economists, but also from the market players and retail investors, because the rupee has never been in such a strong wicket. I mean, today it's breached 60. Very convincingly so. And the FI flows have been not only unabated, but they've been significant in quantum. I think from Jan we've attracted close to $3 billion, which is almost like what we've done in certain years. Mm-hmm. So as I said, so it's kind of all of those things falling in place in a market which was under-owned on equities. So that's, so a lot of short coverings happened, a lot of fresh longs have started taking place. So and it's extremely liquidity and momentum driven.
You know, I love it when guests come on this show and say things like short covering, momentum-driven longs and things like that. Tell us in English what we should be doing right now in a market like this. Should we be getting in? Is it going to be... It's obviously going to be volatile over the next couple of months at least. And, you know, does it make sense then for me to just stay out of it as a retail investor? Because there's a lot going on that's difficult to decipher, let's put it that way. So should we then wait until maybe results of the elections and then get in, or should we be at this point getting into, you know, the sectors that are doing well, like infrastructure, like real estate? We saw PSU banks do really well this week. What's your advice to us?
Yeah, so you know, as an investor, I think it remains the golden rule is always rely on valuations. It's extremely difficult to time the market. Investors shouldn't look at doing that also. It's traders whose job is to time the market and make money out of it. But for investors, it's always valuation. And if you look at valuations of certain sectors, of certain stocks within those sectors, there still could be some headroom or you know, rational potential for growth. But if you feel that some of the stocks have actually run up much ahead of earnings, you don't need to buy anything. So you need to look at stocks which are very clearly under-owned, undervalued. Look at L&T. People love this stock. It's gone right from 780 to 1280 kind of levels in a swoosh, and nobody's kind of participated, especially retail investors. Now they love the stock, but at 1280, if you ask me, it's slightly, while there is momentum, and I don't see any reason why it can't breach 1400 also given the momentum. But for a long-term investor, it's likely that it could come back to 1000 and you know, you really don't make money. So you need to buy it at the 1000 level where the valuation is compelling enough and the downside risk is much lower, not otherwise. So go very specifically by fundamentals, and then valuation is the prime driver out there.
Let's talk about the mid-cap space, and I'm going to bring up the index on mid-caps on your screen. You'll see how it's done this week. In fact, over the last 2 weeks, mid-caps have done fairly well, and they've come back into focus. Tell us how we should approach mid-caps at this point. Is this something that, as investors, we should be getting in? Because mid-caps are difficult to call. And mid-caps also tend to fall first when the market turns around. And it's very likely this market may turn around at any point. So should we be getting into mid-caps at all at this point? Or would you rather advise us to stay with the blue chips?
As investors, I think you should stay away from mid-caps even now. As I said, there's very clear momentum that's there, but it's very difficult to move in and get out timely. You could be buying into at very high levels and expecting that the stocks still are likely to do well, and you could end up actually having a 20-30% reduction, which is so sharp that you really don't get a chance to move out, as you said. Staying with blue chips always pays off, especially in volatile times. But I'm saying, why wouldn't investors want to invest into mid-caps when they're undervalued? You know, you don't have to wait for a rally to give you a wake-up call and say, hey, you know, look at stocks. They've done so well and you should be investing. It's the other way around. Today is a great time to sell, but not necessarily a great time to buy mid-caps.
For those of our viewers who are holding BHEL, and they've been holding it for a while, it's been disappointing for a very long time. It has notched up over the last couple of weeks. What should we do with BHEL? Get out of it?
I know I might sound like somebody who's come as a prophet of doom and, you know, talking about booking profits and everything that's moving up, but some of these stocks which have run up much ahead of their earnings on the basis of just sheer hope and expectations and not really any promise on the operational side, I think it's time to book profits. It's always prudent to book profits, and people have gotten at 102, 110, you know, 120. I mean, you're making a great 30-40%. I mean, why shouldn't you take that in? Because that's exactly what you want to invest into stocks for. So instead of hoping that it's going to cross 200 and move to 240s, just take profits away.
Let's take a few questions. Vijay Haran has written in 40 shares of Cipla, which he bought at 398 rupees. He wants to know what the future prospects of the company are. Will it give decent returns over the next 3 years? Cipla on your screen right now, ended the week at 386. What's your call on Cipla?
Well, I love this stock. It's a great company, great franchise, some amazing brands. But, you know, they've been busy expanding into newer geographies, especially the ROW market, the rest of the world market, apart from Europe and US. And that's taken away quite a bit of the company's bandwidth of sorts. But somewhere that's going to start playing up, and they will start getting re-rated of sorts. We've not seen that crazy chase for a Cipla as much as a Sun Pharma or a Lupin or a Ranbaxy. So my sense is Cipla will also have its heydays. It's still some time away. and he's probably bought it just in recent times. So, and it's been slightly flattish as compared to other stocks. It doesn't even move down as much. I think he would continue holding it.
Right, another question from Sunil. He's holding 300 shares of Jubilant Foodworks, which he bought at 1,080 rupees. He wants to know if he should continue holding on to that stock. The stock ended the week at 1,042. When this stock actually listed, there was so much talk about how the market's never seen a pizza stock before, and we're going to be so excited.
Yeah.
It hasn't really delivered. Should we wait for it to?
I think the expectations were too unrealistic. I mean, because we never had this model, so people are wanting to throw money at it. But if you look at what's changed within the last 6 months for Jubilant, is the input side has come down. The cost. If you look at what they like explaining as single store sales, that's the parameter that Jubilant always talks about. That's come down. But at the same time, the input cost on the real estate part, that's dramatically much lower. They used to be paying an average of about 260, 250 rupees of rent per square foot in prime location, which are now available at 130, 135. So, that comes down dramatically, which gives them the ability to open more stores. The input side on the food cost, that's come down dramatically. I mean, you have tomatoes, which is one of the prime ingredients in pizzas. That's come down, dramatically from what it used to be last year. So I think they will maintain good margins. They will grow. People will start having to look at it much more patiently. And I don't think he's bought it at a very high level. It's almost close to the CMP at this point. He could probably hold and wait for about 1,400 kind of levels in the next 3 to 6 months.
Time for a quick break. When we come back, Prakash will give you 2 stocks that you can buy right now for returns over the long term. Don't go anywhere. Welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. Prakash Devan is still with us, helping us put together a long-term strategy for our portfolios. Now, Prakash has been kind enough to pick out 2 stocks that we can buy on Monday morning that makes sense to add to our portfolios for the long term. The first of those 2 stocks is Responsive Industries, the manufacturer and exporter of PVC-based products. Prakash, tell us why this one makes your list.
If you look at this company, this is one of those mid-cap companies which is significant in size. Absolutely top of the line kind of production facilities. In fact, this facility is state of the art, and if somebody were to visit their plant, you would actually come back very impressed with the quality of processes and equipment and stuff. Unfortunately, they started off at times, and this was post 2008, and things were at a low. The traction was absolutely low in European markets. They supply a lot of material to car manufacturers. In fact, one of the key material goes as input into anything. They're basically nylon cords equivalent. So they go into making so many equipment, so much of products which right from seat covers to flooring to any kind of coating, and they specialize in certain levels of manufacture which are very fine, which difficult to replicate. It's only the Japanese guys who mastered it to some extent, but they're too expensive because of labor issues and all. And this company is, I think, under-discovered of sorts, primarily because it was low on liquidity for some time. But I guess, people need to kind of start nibbling into it. It's not even run up much. I think the 52-week high is about 115, if I remember correctly, and it's trading at just about 10-15% short of that. So it's not even swung both ways and given too much of volatile moves. I believe the company has a good management. They know the business. The expansion is good, and it has an underlying export theme as well. So, if you want to go forward, insulate yourself from what happens on the political scene, you need to look at stocks like that. I mean, the consumption is not going to change if there's an ND or a UPA or a whatever government in power.
What's your target on the stock?
I would believe it should do about 30-35% of an upside in the next 4 quarters. So maybe 135 or something.
All right, 135 on that stock. There's a second recommendation that Prakash has for us this week, and that's Trent Limited. Now, Trent is the retail arm of the Tata Group. It operates West Side stores across India, so that's a name that you can identify with. Now, it's a market cap of 3,375 crore rupees. It recently announced a 50-50 joint venture with British retail giant Tesco to set up the first foreign supermarket in India. That's good news to have Tesco come in. But what's your target, and why do you think Trent is going to...
one of the issues with FDI has been because it's state-controlled, or eventually it's going to be state-controlled, and we are not too sure what kind of a government would come and what disposition they would have, outlook they would have towards FDI and retail. But barring that, if you look at the model that the Trent Tesco JV is following, they are looking at hypermarkets in locations where they're already present to scale up. It's not that they are dependent on venturing into altogether new markets to make sense. Tesco has been anyways, allying with Trent for a long time in terms of the back-end operation. So the synergy is already there. What's happening is this JV actually gets a lot of capital to now start expanding into more product lines. And FDI and retail, mind you, is going to make sense for companies that have their own product lines rather than only sell labeled products from others. And
that's
where the margins
are. A very quick question for you. If we get a government in who turns around and decides that we don't want FDI and retail, what happens to Trent then?
Yeah, so what could happen is you may not get 100% FDI, but FDI and retail has always been there, but with a smaller percentage of ownership. So this anyways doesn't breach that. And Trent continues to supply the input side in terms of processes, know-how, linkages with manufacturers, the scale that they operate. So it's very simple. Trent orders globally. Part of it comes to, Tesco orders it globally and it comes to the Trent Tesco JV, and it makes amazing cost sense. Today, a future retail is not buying globally. Today, Reliance is not buying globally. You have a Tesco doing it globally, and the same suppliers could supply to this JV. So I'm not talking about just West Side. You have the Star Bazaar, which is where their eye is. That's going to scale up because that's something which is non-discretionary staple stuff. You have to buy groceries. You have to buy your FMCG, toothpaste, shampoos. You can't do without it. That's where they're going to step in.
All right, so two stocks there that Prakash brought to us. He talked about Trent Limited and Responsive Industries. That's on your screen right now. Let's take a viewer portfolio. Vivek Kumar has written in. He's our lucky viewer this week. We're going to look at his entire portfolio. He wants to know which of these stocks he should be holding on to. He has 390 shares of Sun Pharma, which he bought at 200 rupees. Well, congratulations on that buy. Should he hold on to Sun Pharma?
I guess yes, because it's a fairly defensive stock. He's not overpaid at all, and I don't think it's going to move down in a hurry. So he could continues to making some organic growth on that.
We have 30 shares of HDFC Bank bought at 650 rupees. Hold on to HDFC as well.
See, HDFC beyond 780, 790 could start getting overvalued. So he could book profits if it touches that. Otherwise, he's got to be happy with what he's sitting on.
BPCL at 360 rupees. He's making a profit here as well. Hold on to BPCL?
Absolutely not. He has to get out of this because these OMCs have run up as the first driver of the hope rally. And I don't want him to be holding it if it becomes a hopeless rally. So he needs to book profits out of that.
220 shares of SpiceJet bought at 35 rupees. Now, SpiceJet ended the week at nearly 14 rupees. There has been some talk about new routes that it plans to add, but the airline business on the whole, does it make sense to hold on to SpiceJet?
This is going to be a pain point because he's really overpaid. He's paid, I think, at almost one of the recent peaks that Spice has seen. If he loves that sector, he needs to be in Jet. Jet has much more resilience and it could weather the downturn very easily. But my sense is stay out of airlines. It's not for small investors. It's fine to be in a glamorous industry, but it never pays off because it can go down so fast because the moment your capacity utilization attains lower levels beyond, let's say, lower than 70%, your fixed costs kill you. So it's an extremely dicey business, and worldwide, the number of businesses in the airline sector that have died is the maximum. So you need to understand that. So you ride the curve upwards, but don't wait for the downturn.
All right. So it makes sense to get out of that stock right now. That's unfortunately a little bit of disappointing news. Prakash, thank you so much for spending time with us this weekend and answering our questions. If you have a question for Prakash Devan, write to us on the email ID that's at the bottom of your screen. Coming up after the break, a conversation with Puneet Nanda of ICICI Prudential Life. He'll tell us what he thinks this market is doing right now and where it's headed. Don't go anywhere. Welcome back. You're watching All About Stocks in ET now. Thank you for staying with us. Now, earlier this week, I caught up with Puneet Nanda, Executive Director at ICICI Prudential Life Insurance. Now, Puneet has been managing money in our stock market for decades, and we decided to take advantage of his experience and ask him what we should be doing in a volatile market like this one. For investors who are looking at their money at this point, and you said it's very likely we'll see heavy volatility over the next 6 months, and then we'll know what the next 4 to 5 years are going to look like. Does it make sense then for me to keep my money in cash and just wait out this period? Because there is the risk of me getting in, like most retail investors do, at a high point. So how do I balance that out?
There are different ways of looking at it. Yes, one option is to stay in cash, ride this out, but it could result in opportunity loss. For example, if one does get to a strong, stable government, actually, one could lose out on opportunity. On the other hand, I think there are some strategies as retail investors one could apply, and one of the strategies could be to start in a in a money market kind of instrument, whether through ULIP or whatever. The money market rates are still fairly attractive. You still have about 8% or thereabouts, and on a systematic basis, it could be on a fortnightly basis or on a monthly basis, keep switching into equity. That way, one will be able to absorb volatility. One will be able to ensure that one doesn't miss out. At the same time, if at all there's a significant correction in the market, one won't have lost out that much. Also, by the way, this is a time-tested strategy which works during all volatile times.
Also, give me now your view on the interest rate cycle at this point for those of our viewers who are in debt funds, income funds, in ULIPs that are tilted towards debt and income. What can they expect over the next couple of years at least?
See, interest rates depend on a whole host of factors, macroeconomic factors. But the most important factor, of course, is inflation, and RBI itself uses that as one of the targets. The recent data seems to suggest that inflation is stabilizing, perhaps even coming off. On the other hand, there are other factors at play. The fiscal situation of the country is improving, the current account deficit is improving, but the borrowing levels are still high for the government. So on a medium-term perspective, I do feel that there's a fairly good chance of interest rates starting to come off. However, in the short run, it will depend to some extent on RBI actions and to some extent on the kind of borrowing program that comes up, which can put some pressure initially on at least the government bond rates, which may or may not translate into rates for the retail individuals. So again, in a way, it's a bit of a story similar to equity, where for the next 5-6 months there perhaps not enough clarity, but from a slightly medium-term perspective, from this level, interest rates are more likely to come off, I think.
All right, so if you have questions for Puneet about anything you heard or for Prakash about anything he said on the show, write to us. Email ID is at the bottom of your screen. You can also reach me on Twitter. I'd be more than glad to hear from you. Thanks so much for watching.